When it comes to investing, everyone wants to maximize their returns. However, high returns often come with high risk. This is why it's crucial to understand the truth about risk before diving into any investment opportunity. By uncovering the best high-return investments and learning about the real risks involved, you can make informed decisions that will help you achieve your financial goals. Whether you're a seasoned investor or just starting out, gaining a deeper understanding of risk and reward is key to building a successful investment portfolio. And that's what we're going to talk about in this video. So, watch this video till the end and we will uncover the best high-return investment and the real truth about risk. Hit that subscribe button and let's begin. There is no return without risk. This is something that a lot of new investors and even investors who have been in the market for a few years have never had to deal with. We've been spoiled by a stock market that only went up, but there is an inevitable trade-off between risk and return. We're just starting to see it come back in 2022 with multiple sell-offs in the Toronto Stock Exchange, TSX. High-yield bonds are just debt borrowed by companies with a lower credit rating, which is anything below a BBB rating from Standard & Poor's or a Baa rating from Moody's. Depending on their rating, bonds are either investment grade, junk, or high yield. These ratings are based on a company's financial statements, how much debt it has, and its ability to pay. I hate that high-yield bonds are called junk because they aren't. The default rate on high-yield bonds is higher than that of investment-grade bonds, but it's still less than 1%, or 1 out of every 100 bonds. Now, that fund lost about 10% last year because the dollar was stronger, but it only trades for 18.8 times earnings, which is 17% less than the 23 times earnings ratio for US stocks. Right now, that government intervention and the risk of being taken off the US markets have hurt Chinese stocks. Shares of Alibaba, ticker Alibaba, are down 62% from their high point last year. It's a great company that has an advantage in e-commerce and trades at a steep discount, but there's a chance it could lose more money. China is a good example of the risks that come with investing in stocks in emerging markets. For investors willing to take the risk of government interference or geopolitical issues between two countries hurts the stocks, but a rebound can give you great returns. One of my favorite high-return investments is options trading, which can also help you lower your risk. Options are another way to invest in stocks. With an option, you get the right to buy or sell shares of a stock for a certain price from now until the option expires. If the price of an Apple share goes up by 10%, from $136 to $150, which is a gain of about $14 per share, then the price of the option will go up by about the same amount. Instead of being worth $2.50 per share, the option will now be worth around $36.50 per share. This means that instead of getting a gain of $10 on the shares, you got a gain of $62 on the options contract. This is just a quick and dirty explanation of how options work. You are risking your entire investment, and this isn't like stocks where if shares of Apple fall 10%, you still have those shares and are ready for a rebound once those call options expire. If shares of Apple haven't gone up, you're out all that money, so you're taking a lot more risk for that higher return. The real power in penny stocks comes from finding companies with a market cap of less than $500 million that are ready to take off. Here on the channel, we've got a 64% average return on the penny stocks we recommend, with 9 that have more than doubled in the last year and 1 that's up 500%. However, just looking at that penny stock list and seeing that 40% are lower brings up an important point. Money market funds and safe bonds offer low but relatively safe returns, which attract investors with low risk tolerance. However, there aren't as many investors willing to take as much risk as you get in emerging market stocks, so prices have to go up to attract buyers. This trade-off is really set in stone because investments adjust almost instantly for levels of risk and potential return. Startup investing is putting money into early-stage companies through venture capital firms or angel investor groups before they go public. A study by Willamette University of nearly 3,000 early-stage investments found that investors made an annualized 27% return on their money over any 3.5-year period. That's 2.6 times your money in less than 4 years. This is a high-risk, high-return investment, though, and more than half of those new startups are likely to return less than your original investment. You invest in a portfolio of 5, 10, or even 15 companies, and a few of them can give you returns of 10 to 20 times what you put in. Before the Jobs Act of 2012, only wealthy investors with a net worth of more than $1 million could invest in these, but now anyone can invest through equity crowdfunding platforms like Republic or AngelList. This isn't like picking stocks, though. The risk is that investors don't do as much research on startup companies, so you'll have to do a lot of your research. This means looking at the financial statements, analyzing the product and the market, and making sure the management has what it takes to make that business a success. We still need to talk about the highest return investment, but the real question is why it's important to know about it. I'd like to tell you about a low-risk, high-return investment that can earn you up to 9% interest on stable coins. There is a lot of demand for stable coins right now from money managers, banks, and institutional funds. A stable coin is a type of cryptocurrency that locks its value to the US dollar. It does this by holding a reserve of dollars so that the price of each stable coin stays at $1. For example, the USD coin or USDC is a stablecoin backed dollar for dollar in a vault account. International money transfers, managed contracts, and even arbitrage trading all use stablecoins. The demand for stablecoin lending has increased significantly as a result, and cryptocurrency platforms may now offer interest rates that are up to 100 times greater than those on bank savings accounts. In conclusion, investing comes with risks, and investors need to find a balance between risk and return. High-yield bonds, emerging market stocks, and startup investments are high-risk but offer high returns. Options trading and penny stocks also offer high returns, but they come with a higher level of risk. It is important to do your research and understand the risks before investing in any asset. Lastly, stablecoins offer a low-risk, high-return investment option for those who want to earn up to 9% interest. In investing, knowledge, research, and a good risk management strategy are crucial for success. If you learned something from our episode today, share this video and give us a thumbs up. Subscribe to our channel and ring the notification bell so you'll be the first to know when we have new video uploads. Thanks for watching and see you on our next video.